Everybody, welcome to the morning market briefing. It's Friday, if you didn't pick up on that. August 19th, 2022. Hope you're doing well. We got the mics on, camera, maybe it looks like it's on. We'll see. First time doing this. Shout out to producer Logan. Market's pretty red, Ben.
Yeah,
Not great.
no,
Actually, no, it's turned a little bit. I don't know. My screen's.
it seems like a lot of the meme frenzy that kind of came into the market over the last week and a half or so is really getting blasted today. So Bed Bath and Beyond, I think, is down 40%, maybe 45%, depends on what minute you look at. Bed Bath and Beyond, we haven't talked about this much on this call because, frankly, we're a little bit sick of the whole meme trade. I continue to think that Bed Bath and Beyond is very very dire straits. They're still scrounging around for these loans because no one will actually lend them money. They're probably going to go bankrupt, and yet people continue to buy the stock. So Ryan Cohen was an activist in the name, but he sold it all. He announced that yesterday. Now it's down 45% or so. Today, Bitcoin also dropped about 7.5% in a straight line. If you look at the intraday chart at 2:30 in the morning, it just went no bid, and it just dropped. It went down about 8.5% at one point. And I'm not sure where it is right now, but it was down 7.5%. When I looked, it took a lot of the other cryptos with it, and I think that you're starting to see a little bit of that impact. Really go through the markets, and I think that may be also be weighing on U.S. stock market indices this morning.
Did you see the college kid that made all that money on Bed Bath and Beyond?
Yes. Yeah, he made 110 million. But the question is,
where did he get 25 million to start with?
Right. It said friends and family. He goes to Stanford, so it's
it makes sense.
Yeah, one of those guys, if you know what I mean.
Like when I was in college, man, I was raising money from friends and family to eat at Five Guys at 2 a.m. Like. Yeah. That's the kind of capital I had access to.
$25.
Yeah.
If you had a $10 meal in college, you're like, man, I'm living large. I remember I got my roommate's parents took us all out to Olive Garden. I'm
That's
like, man,
big. Yeah.
I ate enough for a month and just stockpiled that food.
Yeah, shout out to Lowe. When his parents came in town, we'd go to Longhorn. Big time.
That's a good one.
Yeah. Longhorn and Walmart, we kind of
another Darden.
Sneak a couple things into the cart while Lowe's mom was paying.
Yeah. Big time. If you walked into the fraternity house with a 12-pack of Bud Heavy, you were like a big baller. You know, if you were like Southpaw, Red Dog, those are really the
Bud Ice.
Bud Ice, Natty Ice. You know, the $6.99 12-packs were really more our speed at the time.
I feel like people are gonna. Should we keep going? Let's switch gears a little bit. From Budweiser to the Fed's task. Kind of an interesting market dynamic. Tom, you missed the call yesterday. Ben and I kind of talked about commentary from the Fed, trying to kind of decipher where we go from here. I shared that I kind of expected that they would continue to raise pretty aggressively, and I thought they would do so until they overstepped. But given kind of the market environment we're in, how do you kind of break down what the Fed's trying to navigate right now?
Yeah, so they're in kind of a tough spot for a number of reasons. The first of which is that really their active role in raising interest rates should be pushing down or pushing unemployment up. And we have not seen that. We got that, huge jobs report that was a big surprise. And so we've seen the jobs market accelerate a little bit over the last month or so. On top of that, wage increases continue to accelerate. I mean, I think the last reading was up 6.7%, which is above the core inflation number, which is not ideal for them. They need people to be being laid off and therefore wage growth to be slowing or at least retreating a little bit. Also, the markets have done really well over the last couple of months. And so it's sort of a mixed bag where, the logical outcome for them raising so aggressively should be markets down, unemployment up, demand slowing, and we're not really seeing that. And mortgage rates too have dropped quite a bit from the peak. I mean, they're still elevated over 5%, but that makes housing more affordable than it is at 6%, which probably is holding up the housing market a little bit as well. Though we are seeing, I think it was 6 straight months yesterday after the print of lower home sales. So that's definitely slowing, but prices are still quite elevated. So they basically are kind of in this limbo where what they're doing is sort of working. in the sense that the economy is not dying from inflation. It's doing okay, but they really need to do something to curb the inflation, which is still exceptionally elevated. And so we had a couple of talking heads come out. Jim Bullard gave an interview to the Wall Street Journal where he basically said that he's still leaning in towards a 75 bip rate hike, and that they need to do what needs to be done in order to curb inflation because it's out of the bottle now. I mean, they've got to do something, and they can't just stop. I think the direct quote was, why wait until, or why drag on rate hikes until next year? Basically saying, let's just get them done now. And I don't know if you guys talked about the Bank of New Zealand the other day, but they just decided to raise by 2.75% all at once. They were just like, let's rock and roll. Let's go.
Actually, they did a little and then they came back for more. Same day.
Yeah. So they did 50 basis points in the morning, and then they're like, you know what? Let's do another 2.25%.
Can't raise all day if you don't start in the morning.
Yeah. So they just fired into it. And I sort of think that's the way to do it, but we haven't seen that so far. And then Neil Kashkari, again, always in the news, at least for the last month or so, said, quote, as we continue to raise rates, as we continue to raise costs, so to speak, of borrowing across the economy, it should be tapping the brakes on the U.S. economy. And that makes it more likely that we would end up in a recession. So he's basically saying we're not in a recession now, but we kind of want to be, and we need to take the steps to get there.
What's interesting about the Kashkari quotes is he keeps saying stuff, and then he kind of pulled it back. So he says he wanted to say, as we continue to raise the cost, so to speak, of borrowing. And then he says it should be tapping the brakes on the U.S. economy. And that makes it more likely that we would end up in a recession. It just kind of keeps going back. And he's like, I don't want recession, but maybe just a little bit, maybe a little recession might be good.
A little don't believe me, just watch action there. Biden, meanwhile, and his admin, they're shifting the vaccine and treatments for COVID off of essentially free access to private pay. We've made a big deal about shots in arms. Now they're saying pay for your own shots in arms. Unless you want access and can't afford it, we'll figure it out. I mean, this is one of those things where they're going to have a meeting coming up later this month. They'll have some kind of off ramp. To me, this is as big of a clue as any that it's just like they're done with the COVID thing. They're even passing the buck to individuals and saying we don't have to be the heroes to save everyone from this again.
Yeah, I think that's the case. And I think that a lot of the common line of thinking will be that the cost of COVID, like all these drug manufacturers, Moderna, Pfizer, will really be hit by this because you're not going to have the government just buying millions and millions of doses. But the flip side of it is when it's not the government buying, that the price is going to be raised substantially. And the insurance company is going to pay it. So get ready for your insurance bills to go up because this is going to be embedded in the costs for 2023 plan. And they're going to be prepared for it. The insurance companies is going to have this dialed in. The pharma companies are going to be just happy to charge as much as they want. The insurance company is going to be able to pass that through. And I think that insurance bills next year are going to increase markedly from what they are today. So that's your next leg of inflation, Fed.
Yeah, here's a great way to curb wage inflation is to raise taxes and also raise the cost of healthcare.
Just make it more expensive.
Yeah. So you get the same paycheck, you just get less of it every time.
That'll work. John Deere was down as much as 6.5%, now down about 3.5%. Reduced guidance on kind of the lower end of their construction stuff. So think ride-on lawnmowers. Ben, what do you see from their quarter?
Yeah, I was a little bit disappointed by this, given what they had said last quarter. It seems like they're really battling some continued supply chain issues, which seems odd because a lot of the auto manufacturers are kind of coming back. We looked at Cisco yesterday. They're saying that component availability is improving, but Deere is definitely getting hit by it. They are putting through some more price increases, although not as significant as they did last time. So in the small ag and turf, so your lawnmowers, they're going to be up 9%. Previously, they thought that was going to be up 8%. On the large ag, so your big combines, your tractors, that's pricing is going to be up 14%. But that they had already guided it. That was going to be up 13%. And then on your construction business, they do expect pricing to be up 5%. Previously, they expected it up 3%. So they are getting some movement on pricing, although in contrast to some companies, it's not enough to offset margin degradation as a result of the supply costs. Importantly, for people on this call, the global road building business was one of the only construction areas that was actually reiterated. They reiterated that guidance to be up 0 to 5%. So good news that that wasn't taken down, but a lot of the other guidance was taken down for the year. Overall, they said that demand should be really good for 2023, and they're working with their factories to make sure that they have adequate supply. But right now it seems to be a supply issue for them more than demand, although I wouldn't be surprised if some demand is hitting on that ride-on lawnmower segment too.
All right. Shout out to the road builders getting Georgia home. Ben, next week, we've got student loan forgiveness, some kind of announcement likely coming. Maybe we could get Melissa Visible, who does our financial planning, to come on, chat about that. What else are we looking at?
Yeah, I think that's going to be a big one because no one's ready to pay it. The people who haven't been paying aren't ready to pay it. And the bills are supposed to come due on September 1st. Even the people who are sending out the bills were told, don't send out the bills yet. So if they don't do something on that, there's going to be an issue. My base case is that this gets delayed one more time, in contrast to what the administration has previously said. And I think that some student loan forgiveness is probably going to happen, although I think it's very notable that the Biden administration has waited this long to do it, and it's not winning voters right now. It's definitely losing voters because Joe promised that he would forgive $10,000 in student loan debt in the last election, and that hasn't happened. The other big news I'm watching is NVIDIA on Wednesday. That's going to be a huge earnings report. They already guided down for this quarter, so that's kind of baked in the cake, but it's what they say next is going to be critical. And I think that they're going to have another guide down because the gaming business is weak. But I also think the market's fairly conditioned for that. We got Dollar General earnings on Thursday morning. Do they gain some share from the likes of Target? You have the GDP revision as well for the second quarter. And then, of course, it all leads up to Jay Powell at 10 a.m. on Friday, speaking in Jackson Hole, Wyoming. And it's going to be newsworthy. I guarantee you it's going to be newsworthy. I don't know which way, but it's going to be newsworthy.
Yeah, Friday's going to be the big one. Jackson Hole is sort of the Fed Super Bowl every year, and they're always looking to make a splash. So we'll see what Jay Powell says. I mean, honestly, I don't even have a read of what he could say. I mean, it's just the information is so mixed coming out. I mean, if you look at futures right now, we're right in the middle of 2 and 3. We have a 50% shot right now of a 3-point rate hike. So I think that you're going to get a hard skew one way or the other as soon as he talks. And that's probably what we're going to peg to heading into the next meeting, would be my guess.
Yeah, this is where they've announced QE, Operation Twist, average going from target inflation to average inflation targeting. And I think that Powell is going to.
I hope he just comes out and does like the Jordan shrug.
Yeah.
I don't know, man.
Data dependent.
Yeah. It just comes out and is like, we're watching.
Yeah.
Here's a list of the things we're watching.
Yeah.
And here's a list of things we could do.
My opinions are also transitory.
We'll talk to you guys later.
Yeah.
Yeah, I agree. I mean, I think that's going to be big. The GDP revision will probably get kind of swept under the rug, so to speak, I would think. I don't think it's a big deal, but I do think it's going to be interesting to see what that revision looks like as people continue to debate whether we're in a recession or not. We'll wrap it up there. We'll be back Monday morning at 8:30. Hope you guys have a great weekend. Talk to you soon.